Let's be straight. You're here as you want your limited resources in the form of money, whether it's £100 or £100,000, to grow as much as possible, as quick as possible. And the fastest way for it not to do that is by losing money. For this reason, it's vital that you understand the importance of this graph and its implications when it comes to investing. It'll help protect you from other people and, probably more importantly, protect you from yourself. After all, investing has never been so easily available to us through investing apps such as eToro or Trading 212, where all you need is a smartphone and an internet connection. And for this reason, it's catching a lot more people out than normal. It must be costing investors billions. So, by the end of this video, you'll understand the phenomena that this graph is depicting, and it'll help you better understand how you can apply it to your very own investment thought processes in order to maximise the chances of making good investments and avoiding bad investments. Let's dive straight into it. The graph in question illustrates the Dunning-Kruger effect, and it's named after David Dunning and Justin Kruger, who were the first to discover this psychological phenomenon. The graph plots confidence on the y-axis and competence on the x-axis. These results are from the duo's findings, which were published in 1999 under an article titled Unskilled and Unaware of It, where they looked at participants' confidence levels versus their actual competence levels across several different categories of expertise. The vast majority of participants fell into one of two categories. There were those who were very confident in their own abilities and naturally came out with worse results, and the others which actually overestimated how good other people were compared to themselves, when actually they were performing far better. This isn't a very logical result, right? How can it be that people with good levels of knowledge get less confident as they know more? And equally, why would somebody with little to no knowledge actually maybe be one of the most confident people in the room? Welcome to the Dunning-Kruger effect. It's the very reason why your cousin out of absolutely nowhere starts acting like an expert on geopolitics after just one Netflix documentary. But why is your cousin suddenly acting like this? They're fairly intelligent and a self-aware person. Well, in this scenario at least. So, where did they go so wrong? Well, it comes down to the fact that when you're starting to learn about a new subject, you don't know what you don't know. All you can see is the tip of the iceberg, and that's all you can see, and that's all you know. But what you're not aware of is the 95% of the iceberg that's underneath the water. Your confidence is based on the fact that you think you're a big fish in a small pond when it comes to the knowledge available to you. But what you're not aware of is that you're actually not in a pond at all. Once you continue your journey of discovery with, say, investing, you then find out things like dividend yields, discount cash flows, W8 bends, ISAs, share buybacks. The list is endless. Your pond quickly turns into an ocean, and you don't feel like such a big fish anymore. As you become more aware of what you don't know, your confidence starts to drop. The only time your experience and competency is correctly correlated is when you don't know anything about a subject, so no confidence, no competency. Or when you might be an expert in a field of knowledge, so high confidence, high competency. But that, of course, is quite a rarity. This does make sense and would explain participants who didn't fall into the original two categories as discussed before. So, now you understand the principles of the Dunning-Kruger effect. Let's look at why it is so deadly for investors, and especially new investors who are looking to make money from the stock markets. Well, the Dunning-Kruger effect is at its worst during the worst possible time for any investor on their journey, and that's at the start. But why is that so bad? Well, it's because their bad decisions, which is likely as their confidence is high and their competence is low, is when these mistakes have the longest time possible to compound, turning maybe a small mistake into something much larger over time. Think of it this way. The gains you make in year one will boost your gains in year two, and so on. Before you know it, your initial investment of £10,000 could be making tens of thousands of pounds 30 or even 40 years later. But if your year one performance is horrible, say you manage to lose half your money through a very dumb decision that you make, this loss will lower your returns in year two, which will then lower the returns in the years after, and so on. To bring this to life, investing £10,000 and leaving it to compound over 30 years, say at a 10% gain per year, will give you £198,000 by the end. Or alternatively, if you lose half your money in year one and then leave it to compound over the remaining 29 years, you would only have £90,000. You've managed to lose £108,000, over half the money you could have had, because you didn't know what you didn't know. So, as a sign of respect to those poor noobs out there who have actually lost half of their money before they've even got started, I'm gonna go have a shave. Oh, God, I needed that. So, what might a horrible investing choice look like in reality? Well, it might be new investors who start out by using contracts for difference with leverage. They likely don't know what their exit plan is, have little understanding how CFDs work, and they probably don't even know what leverage is. All these factors and more are the unknowns which have consequences which haven't been calculated for when starting on their investing journeys. If you want to see a real life example of this, then just spend 5 minutes on Wall Street Bets. Going straight into CFDs is like jumping into a Formula 1 car after you've been go-karting for the first time. It's very likely to go wrong. But I actually think there's a worse result that could possibly happen. I think it's even worse for these individuals to get it right first time completely by mistake. And the reason why this is such an issue is that their confidence would then skyrocket and they still wouldn't have any competence to support this behind it. In these situations, new investors then go deeper down the rabbit hole and then they're even more confused at the end of it when they lose it all. The Dunning-Kruger effect does cause further issues that you might not have considered. When you're new and starting out in a field, who are you likely to hear from first? The ones who underestimate their talents and knowledge? Or the ones who are super confident and think they know it all? Well, you only need to take 2 seconds to look at any social media page like Instagram, Facebook, YouTube. People who are coaching or becoming a millionaire even before they've become a millionaire themselves. For that very reason, is that why I have a YouTube channel all about investing and finance, rather than a channel on sales or maybe the industry that I've spent 10 years in? Quite possibly. In fairness though, there is actually one benefit to the Dunning-Kruger effect, which I'll cover off in a minute. So, with this knowledge on the Dunning-Kruger effect, what can we actually do now that we're aware that we do probably have some biases behind the scenes, which makes us more confident versus actually how competent we truly are? Well, the first is to build your experience at the right levels first. If you're new to skiing, you're not going to throw yourself down a black slope on your very first run. It's better you book yourself into a ski school for a few days and then hit some entry-level slopes. The same goes for investing. Should you really use CFDs before you've even owned a simple share of a simple company before? Probably not. It's finding the most basic elements of investing and doing this first so you've got a good concrete base to build all future knowledge on top of. This would likely look like investing into a basic diversified ETF to start off with. If you're looking to venture in something more risky at a later date, then it would be logical to open a small position to begin with as compared to your other investments to start off with, just so you can learn the ropes. But like we've discussed before, if you don't know what you don't know, where do you even start? Well, this is a challenge, and the market is filled with loud voices, with the vast majority of people being of high confidence and low competence. But there is an easy way to cut through it all if you think about it. If the person speaking has to disclaim that what they're saying isn't financial advice, which is a category that I fall into, then it's a dead giveaway when it comes to investing. They shouldn't be listened to for any sort of investing advice. They are unable to put their money where their mouth is, as they haven't been able to or even been bothered to qualify as a financial advisor. What they're doing is either giving you a sneak peek into what they're doing, or they might be doing it for entertainment purposes only. Most people are put off from going to see a financial advisor, but a lot do provide an initial consultation free of charge, just so they can gauge if they have any advice worth giving you based on how much money you have to invest. The beauty of financial advisors is they can actually open the door to show you what you don't know. Taxes, risks, different investment types, exposure, and generally laying out all the different options and potential pitfalls you might run into. And at the end of the day, if they get it wrong, they are liable for the advice they give. They are the experts you're looking for, not the loudmouths that you might find on TikTok. After this, it's ensuring that you read both sides of every argument. What are the pro arguments of an ETF and what are the criticisms? And on top of this, it's worth noting what the individual has to gain from the advice they're giving. Is it more money potentially going into their fund? Or is there a referral link attached below in the description? People do act on incentives after all. But there is one positive of the Dunning-Kruger effect. Imagine a world where no one would attempt to do anything if you didn't have all the information available to you. And remember, there's virtually limitless amounts that you could possibly know about any subject. If it was like this, then it would prevent people from finding out talents that they didn't know they had, as you wouldn't start if you didn't have any knowledge to start off with. And we certainly wouldn't have half as much content on YouTube as we do now. Would I have started investing if I had all the information to hand? Absolutely not. Looking back, I am so thankful I did start, but it sadly wasn't mistake-free. And if you want to hear more about my biggest investing mistake that I'd ever made, then I'll put a video on the screen right now. Thanks for watching. See you in the next one.